Welcome to Economics 1723. This is John Campbell, and I'm going to talk you through the second midterm from last year. Now, last year's exam had 4 questions. We're only going to have 3 questions this year, but let's work through them in any case. So the first question, I'm going to move us down here. The first question asks you to do short answers describing statements as true, false, or uncertain, and give a brief justification. So here are the 5 questions. The first one is stating that the rise in stock prices before companies announce good news about their business is evidence against the semi-strong form of the efficient markets hypothesis. True, false, or uncertain. The second statement is that according to the earnings-based version of the Gordon growth model, a company whose ROE exceeds its cost of capital can increase its market value by retaining earnings. The third question says that an active mutual fund gives its investors a higher average return than a passive index fund if the active fund's managers identify and purchase stocks that have betas of 1 and positive alphas relative to the index. The fourth question says that if the after-tax real interest rate is constant, a 1 percentage point increase in the expected inflation rate must increase the nominal interest rate by 1 percentage point. And the fifth question says that the law of iterated expectations says that the average forecast error of a rational forecaster is exactly 0. So we need to know whether each of these statements is true, false, or uncertain. So let's take a look at the solutions. So the first statement is false because what the semi-strong form of the efficient markets hypothesis implies is that stock prices should respond immediately when news is released, when it becomes public. But before announcements are made, those announcements are not public information, and so the price movements that occur before the announcements don't violate semi-strong form market efficiency. Now, they do suggest that there's private information that was driving up stock prices, and to the extent that that's going on, that's a violation of the strong form of the efficient markets hypothesis. Now, the second statement is true. It's true that if the ROE exceeds the cost of capital, increasing the plowback or investment ratio will increase the stock price. And you can look at this formula, P over E equals 1 minus B divided by R minus ROE times B. And notice that if R equals ROE, then B won't matter. It won't have any effect on valuation, which will just be 1 over R. But if ROE is greater than the cost of capital, then the effect of B in reducing the bottom line is greater than the effect of B in reducing the top line, and overall P over E goes up. And then the solutions just give you some calculus to prove that, but there's certainly no need to do that kind of calculus in your solution. Now, the third question about a mutual fund that has a beta of 1 with an index and a positive alpha, what is that? Does that give investors superior returns? Well, not necessarily, because you have to think about the fees charged by the mutual fund managers. And if they charge a fee that exceeds the alpha, then investors won't get a better return than they would from investing in the index. The fourth statement is false because taxation applies to nominal interest rates. So in class we showed that in the Fisher hypothesis with taxes has to have the nominal rate going up not 1 for 1 with expected inflation, but 1 over 1 minus t for 1 with expected inflation. Because otherwise the taxation of nominal interest will lower the after-tax real interest rate. And then finally, part E, this is true. The law of iterated expectations does say that the expectation of a future forecast error is 0. You can't forecast your own mistakes. Okay, so this is the error, is the difference between the thing you're forecasting and your forecast. And the law of iterated expectations says that the expectation of this and the expectation of this conditional on HT are the same, or equivalently that the expectation of the error is 0. Okay, so that's the first question. Question 2 is a valuation question, an equity valuation question, looking at uncertainty about interest rates. So we're going to have two companies, Value Corporation and Growth Corporation, which should obviously stand for value and growth stocks in general, and they have different long-run dividend growth rates, G in the Gordon growth model. The Value Corp has 1% growth, Growth Corp has 3% growth, and they both have the same initial dividend per share forward-looking. So part A says if the required rate of return for each company is 5%, what are the prices per share of these two companies? Part B asks you to see what happens if long-term real interest rates decline so that the required rate of return goes from 5% to 4%. Part C is the opposite, what happens if rates of return go up to 6%. And then part D introduces uncertainty. You don't know whether it's going to be 4 or 6% now, but soon you will learn it'll be one or the other. And you have to calculate the prices per share of the two companies before the decision is made. Part E asks you to interpret what you've just done. How can uncertainty about required rates of return justify high prices for growth stocks? And then finally, you're asked to think about what happens if the market portfolio is moved by real interest rates. What will happen? What are going to be the betas of these growth stocks and value stocks? And which type of stock will have the higher beta? So that's the question. Now let's turn to the answers. So we're going to start here. We're going to use the Gordon growth formula, which is on the formula sheet. P equals D, 1 period ahead D divided by R minus G. So doing this separately for the value company and the growth company. For the value company, we take the dividend of 10, divide by 5% rate of return minus 1% growth. That's 4%, so 10 divided by 4% is $250. For the growth company, we do the same calculation, but on the bottom we have 5% minus 3%, which is 2%. So that's multiplying 10 by 50, and we get $500. So in part A, the growth firm is worth twice as much as the value firm. Now, what happens if the required rate of return falls to 4%? Well, for the value firm, we're just going to plug in 4% minus 1%, so we're going to get a price of $333.33. For the growth company, on the other hand, we get 10 divided by 4% minus 3%, which is 1%. So dividing by 1% is multiplying by 100, and we get a price of $1,000. Part C, just cranking through. The value firm is worth $200. The growth firm is worth $333.33. Now in part D, what we have to do is use the expectation of the price, where in the future it's going to be one or the other value that we just solved from parts B and C. So the price of the value firm is the expected value of these two solutions that we got in parts B and C. That's the average of $333 and $200, which is $266.67. For the growth firm, it's the average of $1,000 and $333. That's $666.67. Okay, now in part E, what you've got to do is talk about how uncertainty affects valuation. Notice that the expected rate of return before the uncertainty resolved is 5%, but if we compare the prices calculated in part D to those calculated in part A, we can see that part D has higher prices. So for the value firm, we get $266.67 in part D. If we go back to part A, we had only $250. And then for the growth firm, we get $666.67, whereas in part A, we had $500. All right, so the difference is relatively modest for value stocks and larger for growth stocks. Why is that? Well, that's because growth stocks prices are more sensitive to the required rate of return because they have a longer duration, in effect, to use a bond concept. All right, and then finally in part F, the beta of a stock is proportional to its covariance with the market portfolio. Value and growth stocks both have lower prices if real interest rates increase and higher prices if real interest rates decrease. So they're both going to be moving positively with the market. However, growth stocks are more sensitive to interest rates. They'll have higher covariance with the market as interest rates move than value stocks do. So this would fit the empirical fact that growth stocks have higher betas than value stocks. Question 3 is about multi-factor models and the stochastic discount factor. And at the beginning of the question, it sets you up with a reminder that in the stochastic discount factor framework, the expected risk premium on any asset over the risk-free rate is minus the covariance between the return and M, where M is the SDF, divided by the mean of M, which we write M bar. So then the question says that you have a friend who's into this stuff, and she tells you that the form of the stochastic discount factor is this linear function of there's an intercept, and then the market return, and then the return on HML, the Farmer French value minus growth, or high minus low book to market portfolio. And these A, B, and C are coefficients. Right, so then part A asks you to show that if your friend is correct about this form for the SDF, then the expected excess return on any asset is linearly related to its covariances with these returns RM and RHML. And we need to figure out how the slope coefficients depend on the parameters of the SDF model. Now then in part B, we're going from covariances to betas. Betas are just covariances divided by variances, and we show that the model can be rewritten in those terms. Part C asks whether the model is consistent with the CAPM, and there's a sort of clue here, does your answer depend on the values of the coefficients B or C? Explain. Part D tells you that, according to your friend, the coefficient C is positive. What does this tell you about the way in which the marginal utility of investors varies with the return on value stocks relative to growth stocks? Finally, economists have proposed both rational and behavioral explanations for a positive coefficient C, and you're asked to give one example of such an explanation. Okay, so turning to the answers, we're just going to take this form for the SDF, and we're going to plug it into the formula for expected excess return, so that excess return is minus the covariance of Ri and M, but we've just substituted in for M here. We're still dividing by M bar. And then we expand the covariance term. The covariance of Ri and this linear combination of things is simply the linear combination of covariances with these things. So we get B times the covariance of Ri and Rm plus C times the covariance of Ri and RHML, all divided by M bar. Or we can take B over M bar times this covariance plus C over M bar times this covariance. The slope coefficients are proportional to B and C, respectively, and inversely proportional to M bar. But of course, M bar is always pretty close to 1, because it's 1 over 1 plus the risk-free interest rate. So the coefficients do depend on A indirectly through M bar, but not in any direct fashion. So that's part A. Part B, we can just substitute in betas, but essentially by multiplying and dividing by variances. The beta is the covariance divided by the variance, so then we multiply again up here. Now we get the slope coefficients proportional to the variances of the factors that make up the SDF. Now part C, remember, is asking whether this is consistent with the CAPM. Remember that in the CAPM, expected returns have to be proportional to beta with the market. The only way we can make that true is if we make C equals 0, so that'll shut down this second term here. Now, is that enough for consistency with the CAPM? If we make C equals 0, we get this expression, which is just the first term from above, but we still don't have the expected excess return on the market, which is what we would expect to have multiplying beta in the CAPM. However, if we let asset I be the market portfolio, then we're going to set I equals M, and we're going to note that the beta of M with itself is 1. So that tells us that the expected excess market return is B times variance of market divided by M bar. So we can substitute it in right here, and then we'll get the CAPM under the assumption of C equals 0. Now what about the last two parts? We want to know what has to be true about marginal utility for C to be positive. We basically have to have that if C is positive, HML is paying off in low marginal utility states. In other words, it's paying off in good states rather than bad states. And that is what would explain value stocks being risky and having higher expected returns. Now, finally, part E asks you to give explanations about why there might be a positive C. And we can draw on lecture 9, where we talk through a couple of examples. One rational story is that marginal utility falls when investors' human capital does well. In other words, when they expect to be making a lot of labor income in the future. And there is some evidence that value stocks tend to predict national income, future national income growth, and hence wage growth. A behavioral story is that irrational investors just like to buy glamorous growth stocks, which are favorably reported upon in the press and online. And this forces rational investors to end up owning value stocks. So then in equilibrium, the marginal utility of the rational investors will depend not only on the performance of the broad market, but also on the performance of value stocks. And of course, what we're doing here is assuming that the M that determines expected returns in that model is the M of the rational investors, the marginal utility of the rational investors. Question 4 is a fixed income question, and you're supposed to think about working for a hedge fund that does fixed income arbitrage. And we're talking about an imaginary country of Helucia. And we're going to talk about dollars and cents just to keep things simple. And you're given an initial yield curve for the Helutian government bonds. And we have a price of 95 cents per dollar at 1 year maturity, 88 cents on the dollar at 2 years, and 85 cents at 3 years. So part A asks you to calculate log yields and then the log 1 year ahead, 1 year forward rate, and to report results to the nearest basis point. Part B asks you to imagine that you're interested in investing in the 2 year bond, and then at a scale of 10 million, and then short 10 million of 1 year bond to fund the position. Your boss asks you to explain when will this trade make money. So what you want to do is, what you're asked to do is write down the log return on the long side less the log return on the short side in terms of bond yields prevailing now and a year from now. And you have to figure out what will be the break-even value for the 1 year interest rate 1 year from now. And then you're supposed to use the pure expectations hypothesis to relate your answer to the forward rate from part A. In part C, you do something different. The trade in part B is vulnerable to a sudden increase in interest rates, so what you do now instead is you finance your 2 year position by shorting equal amounts of 1 year bonds and 3 year bonds. And then using duration, you want to show that if there's a small change in log yields, if the yield curve moves in parallel, your trade doesn't change in value, it's protected. In part D, you're asked to consider what happens if there's not a small change but a large change in bond yields. What happens to the value of your trade? Okay, so those are the 4 parts of the question. Turning to the answers, part A, simply a matter of using the formula log y equals minus log p divided by m. So you just crank it out, you get interest rates of 5.13%, 6.39%, and 5.42%. Then what you do is you use the forward rate equation, which is m plus 1 times the m plus 1 period yield minus m times the m period yield. And here we want the 1 year ahead forward rate. So we have 2y2 minus y1. What's that? That's 7.65%. Notice that the upward sloping yield curve here implies a upward sloping yield curve from year 1 to year 2. That implies a high forward rate in this period. All right, so moving on to question B, you basically want to see whether the log holding period return on the 2 year bond is larger than the log return on the 1 year bond. The return on the 2 year bond is simply 2y2 minus y1. T plus 1, and then we have to compare that with y1t. All right. So Another way to look at that is that you're going to make money if the forward rate is bigger than the future spot rate. Okay, in other words, if the interest rate on the 1-year bond next period is lower than the log forward rate of 7.65%. All right, I'm going to skip this discussion. But note down here, the pure expectations hypothesis assumes that F1 equals the expected short rate 1 period ahead. So that would imply, the pure expectations hypothesis would imply that your strategy won't make money on average. Right? In other words, there's no money to be made by betting on interest rates of a particular maturity. No money to be made on average. All right, now in part C, you're matching the duration of your long and short positions. All right, but remember that these are zero coupon bonds, so the duration of the long position is 2 years because duration equals maturity. And then on the short side, you divided it equally into 1-year bonds and 3-year bonds. So again, the duration of the short side is 2 years. So because you've got the same duration for long and short positions, so that means that you will be protected against any small change in yields. Now in part D, there's a large increase in yield. What you've got to do is observe that the value of each bond will be reduced by a factor of e to the 0.05 m, where m is the maturity of the bond. So the new value of the position will be like this. There's, you're losing $5 million divided by e to the 0.5 on the 1-year short. You're losing $5 million divided by e to the 0.05 times 3. On the 3-year short, you're gaining $10 million divided by e to the 0.05 times 2 here. So overall, you're losing $11,312.82. So what went wrong? Well, you matched the duration of the long and the short side, but then the problem was that your short position was more convex than your long position. So this convexity is what hurt you. It hurts you when interest rates. Convexity is a property that benefits you on the long side and hurts you on the short side. And you took a short position which was more convex than your long position, and that's why you made a loss. So a hedge that's effective against a small change in interest rates may not be effective against a large change in interest rates. And that is the end of the exam from last year.